with interest rates going up, cap rates are going to be lumpy. They're not going to go up in lockstep with interest rates. Interest rates are determined in a publicly traded market, therefore they fluctuate every day, and they're very volatile. Cap rates are lumpy. They reflect property sales, which take months to conclude and close, and so there's really, I think, a delayed relationship between cap rates and interest rates. Now, some would say that that relationship now, that spread, is, and it's true, it's at a historic high. It's about 150 basis points higher than it has been over the last 10 years. So you could make the case that there's some cushion there for interest rates to rise before there is any effect on cap rates. And I think we're about to really see if that's the case. Long term, there's got to be some effect as interest rates go back up. We will see some upward impact on cap rates. Clearly, the industry is concerned about the prospect of rising interest rates, and you can see it in the price of REITs. REITs declined by about 5% last month, and at the same time as the S&P 500 went up roughly 2.5%. So interest-sensitive asset classes like REITs were hit right away. So obviously the industry is concerned, and they should be concerned. Now, I was just talking about cap rates and their lumpiness, but the same is not true for loan terms, interest rates on loans. Those can change on a daily basis or change on a dime as banks and other lenders assess the marketplace. So that can change pretty quickly, and that can have an impact on real estate values as well. Overall, I would expect sales to continue to remain strong overall, and real estate to come through this in a pretty good fashion. The greatest impact of rising interest rates might be on the willingness of investors to take risk. Lately, the trend has been for investors in commercial real estate and really all asset classes to move out on the risk curve. And we see that in commercial real estate with investors moving from core properties in primary supply constrained, mostly coastal markets, to secondary markets, tertiary markets, and opportunistic and value-add assets. So if we see rising interest rates, I think that's going to have a dampening impact on risk, and it's going to, I think, delay that process where we see a recovery in the capital markets, in demand, investor demand for these secondary markets and value-add and opportunistic assets. Interest rates, rising interest rates, I think will create both opportunities and we could say problems or issues. And it'll change the playing field, the landscape out there in the investment market. To the extent that rising interest rates dampen the appetite of investors to take risks, I think you will see some investors pull back, not drop out of the market entirely necessarily, but for those investors who pay all cash or who don't really rely very much on leverage, I think you'll see a clearer playing field for those investors. They will have, I think, a greater selection of assets. And in terms of problems, lenders have become very aggressive recently. And there's some concern that, maybe they're becoming too aggressive. And I don't know if we're there yet. But to the extent that deals recently have been done that wouldn't get done without the generous loan terms, I think in 3 years when those deals are ready to be, the loans are ready to be renewed, we'll have to wait and see if cap rates have gone up, if the loan terms will be as generous, and if that will create a little bit of distress out there for some of those lenders.